What's up, finance virtuosos? Welcome back to the channel. Today we're going to talk about how to predict if a recession could be on the horizon here in 2024. With all the economic turmoil we've seen over the last couple of years, from the lingering impacts of the pandemic to record high inflation, Russia's war in Ukraine, and more, it's crucial to be prepared for the possibility of another downturn. According to the latest projections, economists now put the odds of a recession hitting in 2024 at around 65%. That's a pretty high probability we can't afford to ignore as investors and consumers. The good news is, if we can spot the warning signs early enough, we can take steps to protect our finances and maybe even position ourselves to profit when the eventual recovery comes. No one has a perfect crystal ball, but there are some key indicators the experts watch closely. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. To understand what red flags to look for, it helps to first revisit how some of the major recent recessions unfolded and what caused them. So let's quickly rewind to the last few big ones. Most of you probably vividly remember 2020 and the COVID-19 recession, which was mercifully short-lived at just 2 quarters, but incredibly sharp and severe. It abruptly ended the longest economic expansion in U.S. history dating back to 2009. Businesses had to shut down, unemployment spiked to 14.7%, which was the highest since the Great Depression, and GDP plunged an astonishing 31.4% in Q2 2020. Just an absolutely brutal contraction in record time. The 2007 to 2009 Great Recession was even more protracted and damaging, considered the worst economic slump since the 1930s. This one originated from a housing bubble and subprime mortgage lending crisis. When the bubble inevitably burst, it set off a domino effect of defaults, home foreclosures, and a credit crunch that froze up the entire financial system. Unemployment peaked at 10%, GDP shrank over 5%, and it took years to recover. Going back a little further, we had the 2001 recession in the early 2000s after the dot-com bubble burst, combined with fallout from 9/11 and other global uncertainties. This ended up being relatively mild compared to 2007 and 2020 though, with GDP only dipping briefly and unemployment topping out around 6%. So those examples give you a sense of what recent recessions felt like in terms of their length, severity, causes, and impacts. As you can see, they can play out very differently, which makes them hard to predict with precision. But there are some common factors and leading indicators that tend to raise warnings. First up, probably the most obvious one, a contraction in GDP growth, meaning the overall economic output is shrinking for an extended period. You'll typically see this reflected in weak consumer spending, falling business investment, and rising unemployment as companies lay off workers. The economy already came perilously close to this in the first half of 2022 with 2 straight quarters of negative GDP readings before rebounding. Another major red flag is sustained high inflation, which eats into consumer demand, corporate profits, and ultimately forces the Federal Reserve to raise interest rates aggressively to regain control. Well, as we all know, that's exactly the situation we've been facing, with inflation still running north of 6% annually and the Fed hiking rates at a historically rapid pace trying to get it under wraps. Many economists warn that if they take rates too high too fast, it risks short-circuiting the economy into a recession. Speaking of interest rates, that's another critical factor to monitor. When borrowing costs rise sharply, it makes debt payments more expensive for consumers and businesses, which restricts investment and economic activity. The Fed has already lifted the benchmark federal funds rate to around 5% currently, up from near zero just 2 years ago. Many analysts think their rate hike campaign still isn't done yet to defeat stubborn inflation. Slumping confidence and volatility in the stock market can precede and exacerbate a recession as well. While the S&P 500 and other indexes have recovered somewhat from the 2022 beatdown, investor sentiment remains pretty fragile with persistent worries about where the economy is headed next year. It wouldn't take much of a negative shock or earnings disappointment to send markets into another tailspin based on the current edginess. One area showing cracks already is the housing sector, with both sales and prices pulling back in major markets over the last year as spiking mortgage rates crush affordability. We've learned from past cycles that sustained housing weakness can be a leading indicator and spreads quickly to other areas of spending like home renovations, appliances, furniture, and so on. Finally, you have potential black swan events like a shocking geopolitical escalation, natural disaster like major hurricanes or wildfires, or unexpected spike in energy prices that could deliver a body blow to economic growth and confidence. Black swan events are unpredictable and can have massive, far-reaching impacts on the economy. For instance, a significant cyber attack on financial institutions could disrupt global markets. Similarly, a new pandemic or a dramatic escalation in trade tensions between major economies could cause widespread uncertainty and economic disruption. While these events are hard to foresee, being aware of their potential and having contingency plans can help mitigate their effects on your finances. Those are some of the major signposts forecasters are watching right now to gauge recession risks for 2024 and beyond. Of course, it's never an exact science, and recessions are inherently hard to predict with great precision since they often stem from unanticipated shocks interacting with other vulnerabilities in the system. But by understanding these common factors and leading indicators, you can at least try to get ahead of the curve and prepare for leaner times accordingly. Things like shoring up your emergency fund, paying down debt, diversifying income streams, locking in fixed-rate loans if you can, rebalancing your investment portfolio to be more defensive, and having a plan to cut non-essential expenses if needed. A little proactive planning can really pay off. And for those with the stomachs for it, an impending recession could open up some fantastic buying opportunities for stocks or real estate at fire sale prices, if you're willing to be greedy when others are fearful. Just something to keep in mind when all the gloom and doom is at peak levels. As we've seen before, it often sets the stage for the next bull market to be born from the ashes. So there you have it, folks. Some of the major warning lights to watch for potential turbulence in the economy and markets over the course of 2024. I tried to cover a lot of ground, but please let me know if you have any other things in mind. As always, thanks for watching and for your support of the channel. Don't forget to smash that like button if you found this video helpful, and subscribe if you're not already part of the Finance Virtuoso community. I'll catch you all in the next video. Until then, take care.